All right. Welcome along, guys. I hope you're well. I hope you're happy and healthy and everything like that. So, I just want to kind of simplify trading a little bit more for you. Okay. I, well, first and foremost, we need to understand the fundamentals. We always need to understand the fundamentals, but also we need to stop overcomplicating something that doesn't need to be complicated, if that makes sense. So, everything since I've started making money trading, so since 2020, I would say, the fundamental model, genuinely my favorite model I've ever traded is this. Okay. All this is sideways price action. Okay. Because the market, and this all I'm going to do is I'm going to explain my interpretation for how the market moves before order flow, price action, all these traders start crying. Now, when you see consolidation in the market, that's sideways movement. Okay, it's just sideways movement in the market. Nothing else to it. Most volume is traded inside of these moves, inside of these areas. Now, with that, what we basically have is millions of buyers, millions of sellers basically fighting against each other. There's liquidity in the market. Liquidity is money, but there's no overall direction. So we trade the market when there is a clear and obvious bias. But we can use consolidation to our advantage because price action has a tendency, before it goes lower, it goes higher first. Okay. And before it goes higher, it will go lower first. That's what we like to see. It doesn't happen every time, but that's what we like to see because this is the market pushing away from all the orders and everything that's sat here. There's most volume is in here. Most liquidity is inside here because this is where the candles are moving up and down the most. But the bigger moves don't happen inside of here. This is the thing. You're always going to get order flow traders, footprint, all this special data analysis, things like that. That will say, yeah, the liquidity is real liquidity is in here. And yes, that may be true, 100%. But let's not forget the statistic. 98% of people lose money trading. Now, big players in the market, in terms of people that are moving trillions around every day, they're not winning every time. They're making money fundamentally, but they're not winning every single time. But one thing we have to remember is the market is about, or making money in the market is all about going against the masses. So we need to be doing the exact opposite of what people are doing. So most people are inside of this consolidation. That's why it's consolidation. It's people buying, people selling. There's no one knows whether they're buying or selling. So they just either do both, or there's 50% of buyers, 50% of sellers, because there's not an overall market direction, if you like. So we wait for there to be an obvious market direction. And the way to do that is to get involved in a trend. And the best place to find the trend is always going to be after a consolidationary move like this has happened, which is why I love the phrase of waiting for accumulation, waiting for manipulation, and the aim is to get involved in the market during the third phase, which is the distribution phase, which obviously looks like that right there. Okay, it's very, very simple. This has always been the the source behind it, the reason of me wanting to get into the market, because I will never go into the market without manipulation taking place. For manipulation to take place, there has to be some form of consolidation, which essentially is sideways movement. Now, it's always great if this happens in the Asian session, this happens in London, this happens in New York. It doesn't always work like that, but that's what we essentially want to happen. We want to basically get involved in the market after this. So the way I've always explained it is kind of like doing it the opposite again, because 98% of people lose money when it comes to trading, and there's a 98% rule to everything. 98% of people who are teaching trading aren't really very good traders, if that makes sense. So whilst 98% of people are teaching you to find accumulation on the 15-minute time frame, I teach you to find it on a different time frame. And I don't actually teach you now to look for just accumulation, because looking for accumulation, nothing is decided. If you get to the market and you see this, basically, then you're closing your laptop. There's nothing to do, because you're going to come to the market during the beginning of the London session or the beginning of the New York session when the volatility is due to arrive in the market. If you're seeing purely sideways action in the market, whether that be on a hourly time frame, whether it be on a 5-minute time frame, there's not going to be much to do. And one big thing I've always said is trade when it's blindly obvious. Only trade when the direction that you want to go in has never been so obvious in your life. So when it's moving sideways, it's not always clear. When I see a manipulation move in the market, and let's just say, for example, this move is a result of a much bigger sort of bearish move, if you like. And after I've seen something like this, then it's go time for me. My entry will always be either somewhere around here or maybe somewhere inside of this manipulation move here. Now, people overcomplicate entries too much. I'm going to show you what I would do, or what I do. Because you can either enter at the bottom of where the manipulation distribution phase is, or you can enter inside of it. You can enter in a retracement of a fib level. There's so many different things you can do. Genuinely, it's preference to you. My view is very, very simple. And it's that when I see manipulation, in theory, the high of that manipulation should genuinely act as your stop loss. Okay, it should genuinely act as your stop loss, because in an ideal world, the manipulation high or low, but we're doing a high in this example, in theory, should be high or low of the day. So if you're looking to trade in the London session, the New York session, when you're likely to see a move happening, and you'll get into the market during that session, you can already identify this, well, then you've got a stop loss. So it really depends whether you want a stop loss with this amount of drawdown or you want this amount of drawdown. It's up to you, but the stop loss really could stay the same. There's always an argument to bring the stop loss a little bit more aggressive, which you can do. There's nothing wrong with that. You just have to understand you're going to lose more trades. I do it. I accept it. I've been doing this since 2015. So accumulation, manipulation, distribution. But again, 99% of people teach it wrong. Because if you look at this chart, you can see this doesn't take a genius now to work out that this is bearish. Why is this bearish? Because price is moving lower. There's nothing else to this. Price is moving lower. It's not moving higher. I'd love to know the workings behind anyone that wants to go long randomly here, for example, because you wouldn't. And again, one thing I always say to people all the time is, and this is the best way of simplifying it, So you can write this down if you want, but this is the best way of simplifying it. If I talk to someone that's maybe on a funded account or on a demo account or not really with a lot of high stakes involved, if that makes sense. So the worst case, you lose your challenge or you lose some money on a demo account, or maybe you've only got a $500 account and you don't care about losing the money, whatever. When people come to me and they say, yeah, look, I'm looking at going long here because of this candle moving to the upside. This is what I just want to see if I can go long to maybe, even though I know it's bearish, I'm just going to see if I can go long, grab a couple of points and then come down. My question to them is always, okay, you've decided you want to go long in a bearish market. Are you happy to risk £20,000 of your own money for this trade? And they'll always say, no, never. Why not? Well, because I don't. Exactly. And I'm not telling you to risk £20,000 on every trade. I don't risk £20,000 on trades, but be confident enough to risk £20,000. And for you to be confident, if I said to you now, I'm going to give you £20,000, you've got to put it on a trade, almost like red or black in the casino, whatever. And you need to find a position based on the chart that you see right now. I'm only going to give you this time frame. You've got to put a £20,000 trade on. I guarantee you 11 out of 10 of you are not going long. You're going short because you want the best chance to make a return on the £20,000 trade. So why in your funded accounts are you going long in places like this? Do you see what I mean? It's a little bit of reverse psychology, I guess, but it makes you think. So from now on, every trade you take, you have to be thinking, is the direction obvious? Is there an obvious reason behind the fact that this is looking to go lower or looking to go higher? So in this example, it's looking to go lower. So we only want to look for shorts. Now, if we look at this market, you can see the price went higher. This was today during the New York session, made a high. And then come lower. So already, if you traded with this as your stop loss, it's been protected today. That there is going to be your stop loss. That's protected. You can see that price action has swept above of this area of consolidation here. And then it's distributed lower. So what you actually have is accumulation, manipulation, and then obviously price action shorting off for distribution. This is what people train you to look for, and this is one of the most powerful ways to get into the market. But I'm not going to show you to get into the market this way. This isn't the way you look for the market to do these things. Because again, everyone is looking for this on a 15-minute, on a 5-minute, on a 2-minute, whatever. And when you see it, I've pointed it out to you now, you think, yeah, okay, I see that. I'm just going to look for this. And then everyone will stay on the smaller time frame. They'll look for this exact move. That's not the play. Okay, that's not the play. The play is always to zoom out. It's always to zoom out. Because this is not telling you the picture of what's going on based on everything that's happening here. Where is this manipulation? So, for example, where is this high going? Why is it stopped here? Is there something in here? Is this a retracement level? There's loads of different variables to what this specific move is actually doing. So you can go to a 30-minute time frame, and then the picture starts to look a little bit cleaner. You can see a little bit more going on. You can go to a 1-hour time frame. You then start seeing imbalances appear. You see reasons for why price action is doing exactly what it's doing. You then go to 4-hour time frame, and then you see the whole picture. You see, okay, look, price action in a very bearish market on a 4-hour time frame has given me a higher time frame point of interest. But now, instead of looking at all of the noise which sits on a smaller time frame, you're going to simplify it now. Now it's just a case of looking at the 4-hour time frame, identifying a new candle opening, coming higher, closing lower. That is it. We're looking for that candle because inside that candle, this is going on. This is what's happening inside a 4-hour candle. But now we've simplified it. So you now know, okay, look, this is a CFD CAD JPY chart, for example. This candle began today at 2 o'clock. This one here started at 6 o'clock in the evening. So if I'm trading from 6 o'clock in the evening, I know I can get to my chart 15 minutes before this 4-hour candle closes. So I can get to my chart 5:45 UK time. And I've got 15 minutes just to look for something. And I can see it instantly. And it's then when you look at this from the outside, so now we've zoomed out, you can then start scaling lower. And then you can suddenly think to yourself, right, now I've spotted that 4-hour candle. And now how much more obvious does accumulation, manipulation, and distribution actually look to you? Because you've zoomed out, you've taken a look from a higher time frame. And again, your options in terms of how to actually proceed in the market are very simple. And again, this is overcomplicated by a lot of you. You can either straight up, because we know that the stop loss is here. This is the stop loss. Why? Because that's the manipulation. So we always know that's your stop loss. Okay. And then it's a case of saying, right, I'm going for a short in the market. I'm either going to just press short because I'm away, I'm on holiday, I'm doing whatever. I'm going to look for a 1 to 2 or a 1 to 1.5, whatever. Fine. Or we can dissect this 4-hour candle. So we can take a look at this 4-hour move, know that we started at 6 o'clock. And it's a case of saying, right, is there anything in here which would make me want to trade in manipulation or in distribution, sorry. And you can just go down a couple of time frames. You can have a look. You can see what looks good, what looks bad. Maybe on the 20-minute time frame, you found this imbalance or something like that. I don't know. Or maybe you just press the button. Maybe you've seen this is the 4-hour candle close. This is the low of the candle. This is the high of the candle. You can see there, that's the high. This is where price went to. Well, it closed here. This is where price actions kind of come up to. Maybe, and again, this will be your candle. Right here. So maybe, in this instance, you think, oh, I just want to trade at 50%. Or I want to bring it to an OTE level or something like that. If there's an imbalance in there, there isn't one in this example, but if there's an imbalance in here, maybe you want to enter at the imbalance. Just bringing the stop loss a little bit higher. Trying to get that 1 to 2 or 1 to 1.5 or something like that. There is too much overcomplicating going on when it comes to trading. There is way too much going on. And this is all about simplifying how the market moves. Again, you can see here in an overall bearish environment. I was looking at shorts from this all day today. I just couldn't get an entry. But I could have if I'd have just pressed the button. Because look, once again, you can see this 4-hour candle closes down here after sweeping above all these highs. If I was to go to a smaller time frame, look at what you suddenly see. You see what everyone's looking for, but they can't find it because they're too busy stuck in their own egotistical minds trying to look for this consolidation. And then they see this big move higher. And because on a 15-minute time frame, without the bearish move coming down, they think this is suddenly going higher. So they start buying. And then they wonder why they're losing in the market because it's gone against them. As well, what you've done is you've come to the markets and you've waited for this actual 4-hour candle specifically to just close. So you'll come into the market at 11 o'clock UK time or 7 a.m. New York time, whatever, because this candle is closed. And your job is, again, it's very, very simple. You either physically just take the trade like that, which you'd be in profit for today. And that, by the way, is for what? 3, 4, 5 minutes of work today. And you're out chilling with your friends, your family, you're doing whatever. You're sat in profit by now. Fine. I know this is going to move slower. I get it. I understand it. But it's time to put our big boy and big girl pants on here. We want to make some money. Sometimes the slow way is also the good way. You don't want to lose it in 5 minutes, do you, lads? Like, come on. It's all about understanding the probabilities and of this particular move. Again, my entry in particular was trying to get price action to either come into that imbalance. I was looking at that imbalance there. I measured the range, and I think I had it up here, and it just never came down in the end. And that's fine. I'm happy to miss them. I don't get them all the time. If I'm away traveling, I would have entered off the 4-hour candle. If not, maybe I look to go a little bit higher, and sometimes it comes up there. Doesn't all the time, but it doesn't matter if it doesn't, because I know, based on the research and based on my own trading and everything like that, I know these candles happen so much more than people realize. If you can get 2 or 3 of these a week, there's always going to be situations where this type of manipulation move is going to occur. Even there, like I can see now, just looking at a 4-hour time frame, this move here, I can spot that is pretty much accumulation in the market. So if I was to go to maybe a smaller time frame now and really just kind of dissect what's going on in here, you can see there's kind of sideways movement there. The one that I highlighted. Look at that obvious consolidation, a sideways price action. That is your competition. Your competition, by the way, is sat inside here. Your competition is inside this move, inside all these candles, listening to order flow traders, or not even them, listening to the trend, trying to find where the big moves is, trying to read what's going on inside every candle, trying to wait for the open. When you're chilling on a higher time frame and you're just waiting for the move to happen, you're turning up to the chart. This candle here finished at 7 a.m., 11 a.m., sorry, UK time. So you're coming at the beginning of the New York session, you're taking a trade, and you're off. And even in this specific example, again, maybe you traded that candle there, or maybe you see the wick, maybe it went a bit higher, maybe you did something like that. Maybe there was some sort of reason for you to get in the market again on a smaller time frame or something. But it would have put you in profit, just as today would have had you in profit as well. It's just about being sensible. It's about looking at it from the outside in. It's about waiting for manipulation. The price manipulates everywhere. Okay, price is just known for manipulating higher before it goes lower. Again, look at this right here. Price action manipulates higher. I could tell you now, inside that move is just pure sideways price action. Nobody out there is telling you to get on a higher time frame and look for this, but this is the easiest way to do it. And this is actually going to save you the most amount of time as well, because your trading day has gone from being 5 hours a day, looking at an empty chart, to now, what, 30 minutes at most? That's how powerful this whole thing is. And then again, like today, this candle was lower, it ended up higher, so there was no trade. I wanted this to close lower because I was going to look to see if we could have a short opportunity to this level here. I didn't get the trade confirmation that this candle was going to close lower, so I was off this gold chart within 20 minutes of looking at this candle in the first instance. This happens absolutely everywhere you go. It's just about approaching it in the most sensible and simplistic way possible. Because it's never going to be something you win every time. We don't win every trade. But we know that. It's just about being sensible in our approach. So, for example, like this manipulation here, people could say, yeah, do you think we could take a short on that? Well, you can. It'd be a higher risk because we haven't closed lower. Wait for the moves to happen. Just wait. If you don't take a trade for a week, you don't take a trade for a week. I did a tweet about this earlier. Sometimes you'll have 4 setups in a week. Sometimes you'll have one, sometimes you'll have none. That is trading. That's the reality of what trading is like. It's a game of patience. It's a game that's going to test your emotional discipline. If you can get on board with that, you can be an extremely successful trader. So, hopefully, you have found this insightful. I will stick around to anyone on the live stream for a Q&A, but to anyone watching this on the recording in the future, I will see you on the next one.